In this video, we're going to have a look at buying shares in a company as an investment option. When you buy shares in a company, you're buying part of the ownership of that company. So for example, we have Company Proprietary Limited, and Company Proprietary Limited has 11 shareholders. And you are one of those shareholders. You are the person in the middle that owns 62 shares. So as you can see, each shareholder owns a different amount of shares in the company. In total, Company Proprietary Limited has 1,000 shares. So you owning 62 shares means you own 6.2% of the company. So assuming you're an ordinary shareholder, because you are a shareholder in the company, you are entitled to dividend payments, and you're also entitled to vote at company meetings to make decisions as the owner of that company. When you vote as a shareholder, you vote in accordance to your percentage. So your vote is worth 6.2%. Now that is not enough to have control over the company, so you have no real meaningful control over the decisions made by that company. So you would be what we call a passive investor who owns shares, mainly to receive a dividend income and hopefully have the shares increase in value over time. So as investors, when we buy shares in public companies, so companies that anyone can buy shares in, you are only buying a very, very small amount of that company, normally less than 0.1%. So your control over that company is practically non-existent. So that impacts on your process in deciding what companies to buy shares in. You need to make sure that you are doing research and understanding who does have the power to be making decisions in that company. What is the history of the decision making? Have they made good decisions or have they made bad decisions? Because as a minority shareholder, you are relying on the people that are in charge of the company to be making good decisions. So let's explore what shares in companies are in a little bit more detail. So buying a share means you're buying a unit of ownership in that company. So in our example, 6.2% of that company. You become a company shareholder and you can buy different amounts of ownership in that company. Buying a share allows you to participate in the company meetings where certain decisions are made. It also entitles you to receive a dividend payment, and you could benefit over time from capital growth if the price of the shares increase. Remember, you can also lose money if the price of the shares decrease over the time that you own the share. So one of the key concepts of owning shares is getting paid a dividend. And the dividend is the owner's share of net profit paid to each shareholder in proportion to their ownership. So for example, looking back at our Company Proprietary Limited that had 1,000 shares on issue to 11 different shareholders, that company decides to pay a dividend of $5,000. So the $5,000, it's split across the 11 shareholders in proportion to their ownership. So given they've got 1,000 shares and they're paying a dividend of $5,000, their dividend is going to be $5 per share. So each shareholder is going to receive a dividend equal to the amount of the number of shares they own times $5. So you as an owner of 62 shares is going to receive 62 times by $5, which is $310. So when that dividend gets paid, your share of the dividend is $310, and that's paid in proportion to the number of shares you own. So the dividend is the regular income that you can get from a company if it decides to pay dividends. Now, a lot of you big listed companies on the ASX, the public companies, they will regularly pay a dividend. So that means that as an owner or as a shareholder in those companies, you are regularly receiving an income flow. Now, receiving an income flow is an important part of investing because you are putting money into this company to buy the shares. You want to make sure that you are getting a return regularly on that money you invest. So let's have a look at some benefits of owning shares in a company as an investment option. So some of the benefits of owning shares is that there's potential capital gains from owning that asset if it grows in value over time. You get potential income from dividends, and if you invest in a public company, those dividends are normally paid twice a year. And there's also the benefit of lower tax rates if you make a long-term capital gain. So if you own the shares for longer than a year, that's one of the tax benefits that you get from owning shares. So let's also have a look at some of the disadvantages of owning shares. So one of the key disadvantages of owning shares is that the share price of the company can fall dramatically in a relatively short period of time, and it can even fall to zero. So that means you are unable to sell your shares at any value. If the company goes broke and goes into bankruptcy, you are the last in line to be paid. So it is unlikely that you are going to get any of the money you invested into that company back as part of the liquidation process. Now, another disadvantage is that the value of your shares will go up and down from time to time, and the dividend may vary. Now, the variation in value of your shares is a lot more noticeable when you own shares than another investment like property, because every day you can log on and you can see the price of those shares. You can't get that up-to-date, day-to-day price adjustment on property. So you are very much aware that if the price is going up or the price is going down, and it can cause anxiety and stress if the price is continually falling for a period of time, which you may not get if you own other types of assets. So in Australia, if you want to buy shares in public companies, you buy them on the Australian Stock Exchange or the ASX. Now, to buy shares on the ASX, you need to do it through a broker, and that broker is going to charge a brokerage fee. So the amount of the brokerage fee is going to depend on the value of the shares that you are buying. So you need to make sure that you are factoring in that brokerage fee when you are planning on buying or selling shares. And when you are making investment decisions, you want to make sure that you are minimizing your risk. So when you are buying shares in a company, you can reduce the risk of losing your money, diversifying your share portfolio. So this means instead of spending all your money buying shares in only one company, you spread your investment across a few different companies, and you try and buy different types of companies. So making sure that you're not exposed to the same type of business in all the company shares that you are buying. So to help you with your diversification, there is something called the GICS, or the Global Industry Classification Standard. All companies listed on the ASX are classified according to the GICS. The GICS is split into 11 industries. These are consumer discretionary, consumer staples, energy, financial, healthcare, industrial, information technology, materials, real estate, communication services, and utilities. So if you've decided you want to buy shares in 4 companies, you want to buy shares in 4 companies that belong to different industries. So you're going to be investing in 4 different industries instead of investing in 4 companies in one industry. This achieves diversification because if one industry experiences a downturn, the other 3 industries may not experience that same downturn, and protects you from the risk of losing all of your money if your investments decrease in value. So another way of minimizing your risk is researching and making informed financial decisions. So you can research companies through the ASX website, where you can look up their 3-letter code and it'll bring you up information about that company. Available information includes the current share price, the 52-week high and low share price. So you can see over the past year how high and how low the share price has gone. It also helps you to identify if it's currently trading near the peak over the last year or if it's trading near the low over the past year. So it'll help you to see whether the share price is on the up or on the decrease. It also gives you the annual dividend yield, which which is the total dividend paid in a year divided by the share price. So how much income you're going to get back based on what you're paying per share. You can find out the EPS, or the earnings per share, which is the company's net income divided by the number of shares. So each year, your one share, how much net income is that receiving? And you can also find out the price to earnings ratio, which is the share price divided by the earnings per share. All of this gives you information about how well the company is going, how much the company is earning, and it allows you to compare the same information for different companies. So let's have a look at an example. So we'll look at CBA, Commonwealth Bank of Australia, as our example company. And we can see that under the summary section, we can look and see what the current share price is. So on the 11th of October, that was trading at $78.77 per share. It also gives us some other key information like the low and the high price over the last 12 months and where it is currently sitting in relation to that low and high price. It also gives you some information on the dividends, like the annual dividend yield that you can compare between two companies. So next we'll have a look at the key statistics tab and what information we can find under that. Under the key statistics tab, we can find information on the share price for the current day and also for the previous year. So again, including that 52-week high and 52-week low. So we know that over the past 12 months, the highest Commonwealth Bank traded for was $83.99, and the lowest it was trading for was $65.23. Now it also gives us our important ratios, which we can use to compare two or more companies. So the earnings per share is $4.85. So this means last year, for every share that the company had on issue, that share earned $4.85. Now, based on that earnings per share of $4.85, we know the company is currently trading at a multiple of 16.22 times that earnings per share. So that effectively means it would take 16 years to earn the value of that share if the company earned $4.85 every year. So in 16 years' time, you would have earned the value of what you're currently paying for that share. And it also gives you the annual dividend yield of $5.47. In the company information part of the ASX website, you can also get some information on dividend history to see how much per year that they are paying as a dividend. And you can see that whether it's consistent or whether the dividend's going to vary. That's going to impact on your decision, because if you are after a regular income flow from your investment, you want to make sure that the dividend is going to be constantly paid and the company has a history of paying a constant, stable dividend. So we can see, looking at CBA, over the past 5 years, their dividend has been relatively stable. So you would expect that to continue into the future. The other source to get some information on that company through the company information section of the ASX website is the share chart. And this allows you to identify trends in the share price to see how it is moving. So having a look at the CBA, and we're looking from 2009 right through to 2019. So about a 10-year period. So we can see from 2012 through to 2015, there was an upward trend in the share price. So during those 3-year period, the share price was increasing. Since it hit that high in 2015, there has been a downward trend. So that's one area of concern, is it going to continue that downward trend, or has it started to reverse it and now starting an upward trend? So that is looking at a crystal ball, but it's information that you need to think about when you're making investment decisions and deciding on what shares to purchase. So you can use the research that you do in relation to shares to compare two companies. So we are going to compare Commonwealth Bank to ANZ. Now both of those are banks operating in the same industry, so they are easy to compare. So when you compare, you want to look at your ratios. So the first ratio we're going to have a look at is earnings per share. Now, Commonwealth Bank has an earnings per share of $4.85 compared to ANZ that has an earnings per share of $2.19. So the Commonwealth Bank has a much higher earnings per share. So your earning potential is a lot higher in the Commonwealth Bank compared to the ANZ. Now, if we translate that to our price earning ratio, Commonwealth Bank has a price earning ratio of 16.22 compared to ANZ's 12.5. So the Commonwealth Bank is trading at a much higher rate, multiple of their earnings per share compared to ANZ. So although you might be earning less in ANZ shares, you're paying a lower multiple for those shares compared to those earnings. And you can also compare the dividend yield, and you can see that CBA has a dividend yield of 5.47 and ANZ's is 5.82. So very similar in the dividend yield. So you wouldn't make a decision on what company to invest in based on those ratios. That's only one element. You would also have a look at who is running the companies, the financial history of the companies, the future plans for the companies. But it's important to factor in these ratios when you are just making investment decisions when buying shares. So that's a summary of investing in shares as a potential investment option.